Hello and hi, today I am going to explain in more detail and talk about the introduction of this presentation. Without wasting time, the beginning of this presentation will discuss and also explain in more detail and depth about the topic discussed, and at the same time, each subtopic will explain and present based on the correct and accurate facts that are closely related to a particular topic, which is the topic of international banking involvement. And the introduction to the topic will also be discussed and explained specifically before being followed by further subtopics. We will also describe and present in more detail towards the risks that related to the topic or issue in this presentation. On the other hand, the description will be followed by discussing the topic of the presentation, where it has the relationship between the aspect of mergers and acquisition in the international banking sector. Next, it will also be discussed on the best solution to curb and overcome the problems and risks that faced by the development of international bank, as well as explain and summarize the conclusion on the main topic discussed at the end of the presentation.
Thank you to the previous presenter. My name is Najmi and I will introduce you to the international banking evolvement. So, what about the evolvement of international banking? Globalization has changed the structure and daily operations of international banking. Barter was first used for transactions. Traditional currency consisted of stones, gold, and paper. Today, people use money, a paper instrument that regulates the transaction of commodities and services. The roles of international banks alter as governments develop economically. Banks' role in providing credit will shrink as countries develop, but money and capital markets will expand. This expansion has boosted competition for banks, particularly in developed countries, leading to industry consolidation and expanded product and service offerings. Over time, fintech has evolved into a digital component. Fintech has brought in a new era of financial globalization, which evolved into digital banking that digitalizes all traditional banking processes. It enables customers to get financial services without having to visit a bank. International banking has gone through colonial banking period and the modern banking period. Modern international banking can be broken down into three stages: the first wave, the second wave, and the third wave. The first wave began in 1830s and fueled by JP Morgan and Goldman Sachs and Lehman Brothers. Foreign banks increased in the early 90s, resulting in British Empire and colonies decline, creating global conflicts and shifting political beliefs, which make it tougher for other nations to create financial systems or markets. Second wave, on the other hand, began in 1960s when it was dominated by international financial transactions. The growth of the United States as a prominent economic power prompted an increase in its foreign direct investments (FDIs) via multinational firms. This happened when US banks started to expand internationally in order to meet the financial demands of multinational firms. Lastly is the third wave, where it happened in the late 1990s. US, Japanese, German, UK, French, Italian, and Canadian banks dominated international banking. International banking has been changed by national consolidation, cross-border mergers, and the transition to universal banking. Deposits, loans, underwriting, advising, leasing, and purchasing services are examples of universal banking.
Thank you for your explanation, Alif Najmi. Assalamualaikum. My name is Zulaika Najwa binti Mohammad Radzi. Now, I will move on to my section, which is the risk associated with international banking. Risk has been acknowledged as a major issue in international banking development. The growth of international banking is influenced by various risks. However, I will only discuss the three major risks associated with international banking, which are credit risk, market risk, and operational risk. The first is credit risk. Credit risk is the most serious threat to banks. It occurred when lenders or counterparties were unable to meet contractual obligations, and it can be breached through defaults in credit card, mortgage and fixed income securities, exchanges and issued guarantees. In other words, there is a risk that bank borrowers will fail to meet their repayment obligations in line with the terms. There is always the possibility that the lender will default on their promises for whatever cause. Credit risk is most visible in the probability of default on the side of those who borrow. Next, market risk. Market risk is the risk of incurring losses as a result of market price fluctuations. A bank's capital market activity typically influences market risk because the stock market, interest rates, commodities prices, and margin requirements are all volatile. Banks that engage in major financial market investment, sales, or trading are particularly susceptible. Changing equities or commodity prices, interest rate changes, or currency volatility are all examples of market risk. The last one is operational risk, which is the risk of loss due to errors, disruptions, or damages caused by systems, processes, or individuals. Operational risk is low in simple business operations such as financial services and asset management, but it is significant in industries such as marketing and trading. A breach in a bank's security could lead to serious crime. It enables hackers to collect personal and financial information from banks before blackmailing clients for additional payments. Banks lose capital as well as client trust in such a circumstance. Disruption to the bank's reputation could make acquiring funds or activities much more challenging in the future. That's all from me. Now I will pass to the next presenter, Mohammad Haris.
Thank you, Zulaika Najwa, for explaining the risks associated with international banking. Now, I will take over the presentation. Assalamualaikum. My name is Mohammad Haris bin Hafizal. My master number is 20009610033. In my part, I will elaborate on 3 solutions to the risk. Every risk always has solutions. Without further ado, let's get started. The first solution to the risk is setting the right credit limits to essential. When determining a customer's credit limit, the bank needs to spend time assessing the customer's finances. In order to establish if sales have increased or dropped over the last 3 to 5 years, they must look at historical data. When calculating lending limits, it's important to take a comprehensive view of the industry. The bank's credit risk can be reduced by learning more about the sector's behavior and making sure that the bank is aware of its growth potential and any upcoming challenges. With the right information, the bank's credit risk can be reduced and customers' credit limits can be more appropriately set. Secondly, modify the bank's portfolio to lessen the impact of interest rates. Due to increased inflation often leading to higher interest rates, there are a connection between the risk of interest and the risk of inflation. This affects both equities and bonds. Bond prices rise as interest rates are lowered, which raises the net asset value of bond funds. It's not just bonds that benefit from reduced interest rates, even shares benefit from a lower discount rate. The opposite is true when interest rates rise. Those who have their money in bonds can change their maturity dates, whereas those who have their money in equities need to alter their exposure to rate-sensitive industries such as financial institutions. Lastly, the third solution is risk surveillance system that utilize technology. Banks used random audits and spot checks to detect operational risk. Bank audits identify and correct excessive risk exposure and misconduct in a certain area. Human behavior, organizational processes, change objective, and cultural issues are intertwined and produce operational risk. Successful ORM strategies need formal governance and capital needs. Training and leading by example are essential intangibles. Integrative and proactive banks can reap huge financial rewards, but more importantly, they can prevent long-lasting calamities. That's all from me. Now, I will pass the baton to Mohammad Rashdan to take over the presentation. Thank you.
Thank you for the engaging presentation, Haris. Assalamualaikum warahmatullahi wabarakatuh. My name is Mohammad Rashdan Bin Hisham, and today I will be in charge of explaining the relationship between mergers and acquisitions and international banking involvement. I believe we have heard of the terms merger and acquisition before. They are among the most misunderstood terms in business as people think they are the same thing. Mergers bring together two or more businesses to establish a single new business. A new ownership and management structure are formed by consolidating two or more firms into a single entity. On the other hand, an acquisition is when one company buys the business of another. A new company is not formed as a result of acquisition, but when the bigger company acquires the smaller one and absorbs its assets, the smaller business will be dissolved. Did you know that after a steady decline since 2009, merger and acquisition activity in the banking sector hit a 20-year peak in 2020? A total of 1,316 transactions took place throughout the globe in 2020 alone. One of the high-profile and biggest bank acquisitions that occurred in that particular year included First Citizen Bankshares acquired CIT Group. However, as the outbreak of COVID-19 blooms in 2020, bank mergers and acquisitions are expected to be affected by it, and many banks consider acquisition and mergers as opportunities to broaden their reach or develop their operations more effectively. Henceforth, let's look at the mergers and acquisition contribution toward international banking involvement. First and foremost, mergers and acquisitions help banks scale out with geographic diversity. A bank merger helps financial institutions grow and gain customers quickly. The acquisition gives a bank additional money to lend and invest and a broader geographic reach. This approach comprises geographical diversification and a new market growth. Then, technology exchange and development happen through mergers and acquisitions. In the banking sector, mergers and acquisitions help companies to fill product or technology shortage. There is a chance that if a larger bank buys the institution, it might significantly strengthen its IT platform. Lastly, bank mergers and acquisitions also create competent financial institution teams. Due to the larger pool of available talent for management, every bank benefits from a merger or acquisition. To help international banking develop, they will be in charge of developing new ideas to improve banking operations in the future. So, that's gonna be all from me. I will now pass the presentation floor to Mohammad Haikal.
Last but not least, we move to the conclusion part of our presentation. To conclude, the development of international bank has brought many different establishments and has developed to some extent various positive aspects of today's international banking sector. The development of international bank also has now transformed the world of banking into the everyday life of society and making the best changes for all improvement on the banking sector, and also lead in a positive and lasting direction in terms of modernity in the future. Thus, every best solution is needed to reduce the risk and problem involved as well as lead to a better positive side and create a brighter future in the world of international banking. That's all from us and thank you.